Who is INSUREtrust? Well, INSUREtrust is actually headquartered in Atlanta metro area. They are the insurance industry's leading specialty insurance brokerage in emerging risks. And in 1997, INSUREtrust pioneered the insurance cyber liability industry by manuscripting a unique policy form designed specially to cover exposures associated with internet's emerging digital risks. This would later become known as the cyber insurance industry. And for the past 25 years, INSUREtrust has continued to be the leader in the insurance industry with unique, innovative, and expertise focused heavily on cyber and related risk management. With that said, I will turn it over to Michael and Christian.
Awesome. Well, we're going to kick it off, and I'll let Michael begin here just by talking about what cyber insurance is. So, there's a lot of, I'll say, myths or misconceptions about what the product is, what it's designed to cover, where it expands and where it stops. So hopefully we can demystify some of that today. And with that, I'll let Michael begin talking about coverage.
Yep. Thanks, Christian. So for those that have never purchased cyber or maybe first-time buyers, may not have the full picture or in-depth understanding of what cyber encompasses. And I think part of that is the term cyber liability is a little bit misleading in that it insinuates third-party coverage. And while yes, that's an important aspect of it, which most of the time what you're paying for is the first-party coverage. And that's where kind of the differences we're seeing from market to market. In terms of first party, I think the best way to highlight that would be to kind of go through a high-level example. So in the event of a breach, the first thing that would be activated is the breach response aspect of the policy. And by that, we mean legal, forensics, notification, and potentially crisis management and PR expenses. So the first thing that would happen is you contact your carrier, notify them of the potential breach. At that point, the carrier would engage legal or privacy counsel to determine necessary next steps. If it's determined that there is a breach and that forensics need to be conducted, they would then engage a forensics IT vendor to remote into the network, determine the scope and severity, what all has happened, how the system was infiltrated, and who all has potentially been impacted by the breach. At that point, privacy counsel would then get in touch with what they call a notification vendor to properly notify the impacted individuals and adhere by the state laws or regulations in which the affected individual resides in, which state that they reside in. So an example would be there's a breach to an entity and they determine that 50,000 individuals were impacted in California, 50,000 in the state of Oregon, 50,000 in the state of Washington. There's going to be different state regulations and laws for each of those states in terms of notification. Some may say all you need is an email notification. Some may say you need formal mail and email. And some may say, you need that formal notification letter as well as credit monitoring for up to 12 or say 24 months. All of those costs are starting to incur and build up, and that is only just the breach response aspect.
Yeah, so even a couple of years ago, when we were talking with first-time buyers, we would talk with folks in Tennessee, or we would talk with folks in Minnesota or states that didn't have state-by-state notification laws. And one of the myths that we would get pushback on is, look, like, I appreciate the fact that there's legal counsel to negotiate or guide me through the process of notifying, but I don't have any legal requirements to notify consumers in my state. There's no law that exists here. The myth there is that it is not about where the business resides, it's about where the customer affected resides. And that myth is changed today because every state has a state notification law. So we've got them in all 50 states. If you look at, and to Michael's point, as we focus on it being cyber being a first party response or incident response coverage, you're paying for the costs associated that he just outlined, or at least the first few components there, but you're also paying for the team who has experience doing it, and you're paying for the rates that are pre-negotiated with the insurance companies. So another thing, when we've I'll say trade education back and forth with our clients on is the cost of forensics. The cost of forensics right now, as you can imagine, if you're reading anything about cyber in the media, every forensics firm in the country, in the world, is overwhelmed with the amount of work that is hitting their desk. Their normal rate structures in the open market is anywhere from $750 to $1,200 an hour per partner that's on the case. So when you have that extortion incident, you have a team remoting in, depending on the size and complexity of the network. Maybe it's one partner, maybe it's two, maybe it's three, in some cases as many as 4 or 5 partners. When you're working with the insurance companies, those rates are reduced substantially and come down to anywhere between $300 and $450 an hour per partner on the case. And so in part, what you're paying for obviously is the cost and the reimbursement for the cost that we take on in the event of an incident, but it's also the team with the expertise and the rate structure that comes with that. And that applies as well to legal counsel, which Michael alluded to at a pre-negotiated rate. You want to talk a little bit about just extortion, the nature and business interruption and what surrounds it?
Yeah, so what we're seeing in the market today, cyber extortion is the kind of the hot topic, both in frequency and severity when it comes to claims. And by this, what we'll mean is someone infiltrates your network, they encrypt your systems, they send you a ransom note saying, pay us this much in Bitcoin for us to unlock your systems. So not only are you having to pay that extortion demand, you have the breach response costs, but you're now incurring what we call business interruption losses. And the business interruption aspect is really what I like to focus on with our insurance and clients, because it, to me, in my opinion, is the most nuanced part from policy to policy. And by that, what I mean, so a coverage trigger for business interruption will be a cyber event or a breach or a hack to your network, right? But there are coverage modules that we refer to as system failure that will actually expand that coverage trigger to not just a hack or a breach, but it could be an unplanned outage or human operational error. So let's say, for example, you have a system update, it's not configured correctly. You run the update and now you're suffering an outage for an extended period of time. That system failure trigger is designed to respond and not just the breach or hack coverage trigger. What we're also seeing is what we call dependent business interruption. So that's actually at no fault to the insured, but say a vendor that they rely on for operations, if there is an incident that happens to them and then starts to impact the insured's bottom line. So that security failure and system failure coverage triggers, both of those can apply to dependent business interruption. It's just on the carrier on how much, I guess, in limit, or if they want to sublimit that, or how they're going to respond. And so that would be different from policy to policy. With that dependent business interruption coverage too, there's also what we call IT and non-IT vendor coverage. So with the dependent aspect, a large majority of the market, their dependent business interruption language will extend to IT providers that they rely on for operations. So this could be data storage, this could be hosting, cloud providers, but a large portion of the market will have their language only extend to those IT providers in the event of a dependent business interruption claim. But if you think about it, for certain classes of business, it's very important that you have that non-IT provider or non-IT vendor language built into the policy. The most, I would say, obvious example of that would be manufacturing. If you have, whether it be logistics or a supplier that goes down and impacts your bottom line, without that non-IT provider language, no coverage would be enforced there.
Yeah, and we see that in manufacturing, we see that in construction, we see it in a lot of industries that rely on third parties for more than just data storage. We see it in healthcare. There's several industries that rely on that heavily, and it's interesting because cyber in its evolution, and particularly I'll focus on the last 10 years, was originally developed as a kind of PII, or personally identifiable information based coverage, right? So the only people that looked at buying this coverage were folks that were in retail, for example, or online sales, or people that had a lot of financial information or healthcare information. It was all individually focused. Effectively, what hackers and third-party adversaries have done over the last decade is they've learned. They got in the kind of 2010 to 2012 period, and they focused on large retail. So the TJ Maxx's of the world, the PF Chang's, the Targets, the Home Depots, all the ones that people read about, because you could get a ton of information all at once. Well, what they found out was taking that information, trying to monetize it on the dark web takes a long time to do. And as a consumer, my credit card or financial information related to my credit card is only worth something for so long, right? I get a fake charge on my card, I call the bank, they fix it, right? And that card is no longer useful. And so hackers learned from that, and they shifted over the course of the last, call it 7 to 8 years, to focusing more heavily on ransomware. You had, for those of you that do read about cyber in the media, there was a pair of international attacks back in 2016 called Petya Not Petya and WannaCry. And it was exploiting a vulnerability across thousands of businesses around the world. But if it was able to infiltrate the business, the demand with regard to those businesses was only a couple $100. And maybe it was in Bitcoin or Ethereum or some kind of cryptocurrency. But the idea was to get the businesses to pay, because the amount was so small, right? We're not going to go through negotiation. We're not going to report to the insurance company, which, by the way, is not what you should do. But it's the way the business was thought of at that time. And what hackers learned from that day and era was, look, if we can refocus our attacks on businesses that have a reliance on being up and running, right? So more of what we would refer to as blue collar industry. So we're looking at manufacturing, we're looking at construction, we're looking at industry classes that have less PII, so less quote unquote sensitive information, but are 100%, their revenue development is 100% reliant on their suppliers being up and running, their vendors being up and running, their data storage facilities being up and running, in order to accomplish their raw material facilities being up and running, in order to accomplish the projects that they're signing up to their customers that they're going to accomplish within the time periods they say that they'll do it. And so the shift that we've seen, and to Michael's point, when we focus on extortion, like the demand is part of it. You read about in the news, $1 million demand, 2 million, 5 million. We've seen demands in excess of 50 million, $50 million. You're paying for not just the exchange or payment of that demand, but forensics is going to come in, and they're going to get an idea around, okay, this particular hacking group is coming from X region in the world. And as a result of the analytics associated with this particular hacking group, we are recommending that we should try to negotiate them down. There's less of a chance that they've already infiltrated our backups, and they're going to give us our information back if we can get to a point of trading with them. So you're getting that advice and negotiation, as well as access to a cryptocurrency wallet, right? You have that. Cryptocurrency is more easily accessible in today's day and age, but to get it to that level and that degree in a protected environment is something you want to rely on the experts for. So as we focus the two coverage pieces that Michael alluded to on extortion and business interruption, it's the payment exchange, but also the negotiation associated with extortion, the analytics that come with the vendors that are attached to that to talk about what the adversary may do. And then it is on top of that, the access to the wallet, and then revenue loss reimbursement through business interruption, as well as extra expense. So in those same scenarios, like we've seen incidents in hospitality where, you had, Marriott was a well-known one that was very public several years back. There's been others that have been less public, that, the systems go down, they get locked up, there's an extortion demand, hackers becomes impatient, they decide to wipe systems clean. Well, all of a sudden we have, as somebody in the hotel industry, we have no access to the data that shares what rooms have been cleaned and haven't been cleaned, right? So what do we have to do? We have to go out and hire a team to make sure that we go get the rooms cleaned as fast as humanly possible, so that we can get guests back and staying in our hotels. And so business interruption, in the sense of, like, for those of you on the call that, everybody buys property insurance. For those of you on the call, as it relates to property, we have business interruption is for revenue loss. Business interruption in cyber is that business interruption for revenue loss, but a big component for a lot of clients that we work with is the extra expense that comes with hiring extra labor, that comes with hiring or bringing on additional data storage facilities because ours has gone offline. That extra expense component of it tends to play a pretty big part in losses that we see.
I think before we move on from business interruption, the last thing I'd like to hit on is what we call proof of loss or forensic accounting. So in the event of any business interruption loss, it's not where you just tell the carrier how much that you've lost and they take your word for it. There has to be actual proof, right? And so what they do there is they hire a forensic accountant to come up with a proof of loss statement by auditing your financials. They'll look at your P&L for however long and determine, okay, if you were out for this amount of period or this period of time, and this is what you're normally doing in revenue, we're agreeing to reimburse you this much on the proof, according to the proof of loss statement that's submitted to the carrier. Not every policy includes coverage for that proof of loss, and a lot of times there is no coverage there. But there are certainly policies that will offer small sublimits there, or there are some that will have it built into the extra expense language. So that's an important differentiator that often goes overlooked, that we especially like to highlight to our clients.
Yeah, and it's just utilizing that bucket of money to go out and hire a firm to do it for you, or utilize the one that the carrier has approved. We have different schools of thought depending on the client that we talk to. But if you want to, Michael, if you want to spend a little bit of time briefly on data restoration, hardware replacement, but then end with social engineering.
Yeah. So the data restoration aspect can be extensive and it can be costly. So there was one example that I'd heard about a accounting firm that they were unable to restore their information from backups and basically had to recreate data for over 200 of their clients. The cost to do that and the time for hiring someone to do that, it can be quite extensive, and that is encompassed within the policy. What we also refer to, so that's digital asset restoration, but what we also refer to as bricking in the market is replacing of hardware. So not every policy covers this, or some of them they will supplement the coverage, but when we refer to bricking, that would be in the event of a breach, say that there's a server that's no longer operating or bricked, quote unquote. If your server, laptops, any hardware that needs to be replaced, that's what we refer to in terms of bricking, but will be separate than the policies identify as data restoration.
Yeah, and the key there, as you look at bricking, is just understanding that while it is different than property, it is an aspect of cyber that does replace property so long as it is as a result of a cyber attack. So in a lot of these extortion incidents where we have, very malicious malware get in the system, it effectively encrypts the hard disk at a point of no return. So they call it bricking because you have a laptop or you have a cell phone or you have some mobile device that is no longer useful because the hardware within has been destroyed by the virus that was placed by the hacker. So, as we look and work with our clients on what are, appropriate limits to consider, there are clients that we work with and say, like, we pay this much in hardware expense a year, and what I didn't know that, for example, cyber would replace something like that, and we back into what limit we should consider on that basis. So it's not something historically that was covered by cyber, but it is something that's covered by most policies in today's marketplace.
This last item we'll touch on within first party cybercrime. So this is actually the second most common form of loss within the industry. And several of you may have had an incident before or can relate to this quite easily, but what we'll refer to as social engineering would be, you, the client, being duped into sending funds to a fraudulent third party. So say there's an email exchange that's intercepted to your accounting department. It's a vendor you work with frequently, so kind of no questions asked. And they're saying, we recently got a new banking account number, or our routing number is now XYZ instead of ABC. you send those funds over, and a week or two later you determine that that was actually a fraudulent party, and you're out of those funds. That is what we refer to as social engineering, and sublimated on cyber policies, but most, if not, or in most cases, can be encompassed on the policy. The other item that we'll refer to is invoice manipulation, is actually the reverse of that. So an example would be, say your systems are breached and there's someone sitting within your network. They are actually sending an email out from your email domain to that client or vendor, and the reverse happens where they send a new routing number. Your clients or vendors are then duped into sending it to a fraudulent third party, and then weeks later you find out and they're saying, hey, this came from your email address, you guys were compromised, this isn't our problem. And so coverage can be enforced there through invoice manipulation.
Yeah, and it's, as you look at the development and evolving nature of cyber liability, what you've seen, we just talked about hardware replacement being a new item. We're talking about cybercrime or social engineering being a new item. But we're at a point now in the marketplace where we're becoming very defined, in that if there is some kind of digital theft of intangible assets that leads to something, be it tangible or not, it's cyber that is trying to pick it up. And so, with that, I think I don't want to minimize the liability components of the policy, but as Michael alluded to at the beginning, this is a first party response product. The focus of what we're buying this for is the breach response for extortion. The team that comes with those two items is hands down the most important. What comes on the back end, network security, privacy, regulatory fines and penalties, and media liability, is all third party defense coverage as a result of different forms of attack. So with that, we can go ahead and go to the next slide. So just talk state of the market here. And, of course, anybody who is on the call who has cyber or who has carried cyber, had probably, I would say with almost certainty, experienced some type of friction as it relates to the insurance market and their cyber programs the last 18 months. We want to spend a little bit of time talking about why. If you look at cyber as it relates to lines like property, which I've alluded to a few times today, but cyber is very much in its infancy phase. We've been in this market as a business for 25 years, which is as long as the market has been around. That's a very, very young marketplace as it compares to traditional lines of insurance. And what that means is, we've been in a period of time where people were trying to go after market share by adding new coverage, adding new features, cutting price. And effectively, cyber has historically been a pretty profitable line of cover. I alluded to it before, but as extortion began the rise in 2016 and beyond, now we're in a position where insurance companies are seeing anywhere between $5 and $10 million demands and payments a week. Okay, so in just for simple math, without getting too deep in the weeds, the total size of the cyber market from a direct written premium basis, so that's policyholders exchanging premium to the insurance company, in 2020 was roughly 1.7 billion. Okay. We had in 2020 roughly 15 losses that wiped out a third of the entire cyber marketplace as it relates to direct written premium. So of that 1.7, we had roughly 600 million in losses wiped out across 15 publicly known losses. Okay, so those are not losses that you're not reading about in the news. Those are not the small to middle market losses that we are seeing literally every day. Those are just 15, the large ones that we read about in the media. And so while it's different, cyber is different for a lot of reasons than other lines of cover, it's also immature in its size and duration. And so as a result, when you have a third of the market wiped out overnight, what that causes, so when you have an extortion incident, you have the negotiation and exchange of that payment happening generally 24 to 48 hours. Some cases it takes a little bit longer, but generally 24 to 48 hours. We got in a period like in those 15 losses where we had carriers across the world taking in excess of $600 million in losses overnight. And so as a result of that, it's not like traditional lines where we can set aside reserves and make adjustments to underwriting at the end of the year. We, the underwriting community, had to make an adjustment overnight. And so what you saw was effects of the larger macro environment on programs last year. What it has introduced, and I will say the light at the end of the tunnel, is it's created a cyber-based framework where we can have consultative discussions with our clients on where is the best place to spend your IT dollars as it relates to insurance to ensure we're treated in the most favorable light when we approach the market. So one of the bullet points on this slide is increased underwriting. Increased underwriting is scrutiny on what has come out of claims analytics for what is best business practices as it relates to insurance as a result of these losses. And so I'll talk about it here in a second, but it's created a nice framework for our policyholders to be creating a roadmap at the beginning of the year and saying, we need to focus on implementation of MFA. We need to get offline backups. We need to be in a 3-2-1 position, et cetera. And it's also introduced the use of scanning technology. So it's looking at businesses from the outside in. It's non-invasive. It's the functional equivalent of a car driving through a neighborhood, looking to see what doors are open and windows are open on houses. Underwriters are using that scanning technology because in 70+% of losses that we saw over the course of the last 24 months, we had external facing vulnerabilities in those losses. And so what underwriters in the insurance community is trying to do is utilize third-party external scanning tools to let our clients know, hey, you've got an open door here. You got an open window. There's an open port within your system that hackers are going to exploit if we don't close it. And so you're seeing a much bigger push to use of technology to help guide clients prior to renewal or prior to purchase, first-time purchase, free services that says, hey, this is how a hacker would look at you if they were looking to attack. So it's a little bit about state of the market. We can go ahead. I know we're coming right up on time. I want to have time for questions. We can go to the next slide. I won't go through every single one of these. Obviously this webinar is being recorded, so you can take the framework that we put in front of you, or we can talk about what each of these mean within. But I am going to focus on two: multi-factor authentication and digital asset inventory tools. Anybody who's purchased cyber in the past or has ever even considered looking at a policy in the last 12 months knows that underwriters want to see multi-factor authentication. They want to know that when people are signing into the system for remote access to the network, for remote access to email, they want to know privileged users, they want to know people getting in cloud applications, and those accessing backups have a second mechanism or a multi-factor, second factor of authentication to prove that you are who you say you are. And so when we look at maintained or requirements for maintained insurability, all of these are very prevalent with 95% of the market. 99% of the market expects for you to have MFA across your network for email access, for privileged users, and for backups. So very heavy focus on MFA. The second piece of that that we're pushing on every single one of our clients is utilizing some third-party digital asset inventory tool. Again, if you've had cyber or plan to apply for cyber in the future, you're going to be asked the question, what's your estimated record count? What the insurance companies are trying to do and backing into that is understand what their notification exposure is. So depending on the cost per notification per person, they can quantify a rate, at least a part of a rate, based on the record count that you have. Most businesses that we work with, I would say, take a guess at it, say, hey, we have X amount of consumers, we do business with XYZ, and sort of just get a rough piece of math put together for estimated record count. I'll say we do have some that hire third-party consultants to come in and try to quantify their unique data. We are strongly encouraging use of digital asset inventory tools, because these tools are artificial intelligence based. They're tools that you can put on the system to not just quantify how much information you have on Christian and how much you have on Cassandra and how much you have on Michael, but also take it one step further to say, you got all this information on Cassandra and Christian. You don't even need it, right? It's beyond regulatory requirements for us to keep it. Let's get rid of it. We only need Michael's information, and instead of 5 pieces, we only need 2. In the simplest of terms, what these tools are doing is putting our clients in a position to take 10 terabytes worth of information online, minimize that down to only the 3 terabytes that are necessary. So if we ever do have some type of attack, we're minimizing the amount of time we're down to get back up and running as we restore from backup, because we're not backing up things that we don't even need to be storing. So if there are 2 things that we're putting, and every single one of these are very important in our eyes and in the eyes of insurance companies, but if there are 2 things we're weighing heavily on with our clients right now, it's MFA, because you got 1% of the market available to you if you don't implement it within the network, email, privileged users, and backups, and then going through some type of digital asset inventory process with the software tools that exist in the marketplace. We can go to the next slide. And we'll open it for questions.
Again, if anybody has any questions, please go ahead and type those in the Q&A section or in the chat, and we will get those answered. In the meantime, there are a couple that have come through. Can you expand on why rates are going up?
Yeah, so I mean, as we look at, and I a very high level highlighted it before, but as we're looking at the larger macro environment, effectively the way insurance works is insurance companies charge for what they think a particular client should pay based on rateable factors. So some of those are record count, revenue, controls in place, et cetera. What an insurance company does is they actually go out and they buy reinsurance on their own book of business in the event there's a catastrophic loss. So in cyber, that would be Amazon Web Hosting Services going down. Millions of businesses across the world use it. What reinsurance companies want to know is how effective insurers are managing systemic risk for things like Log4j, WannaCry, NotPetya, et cetera. What reinsurers got a big scare over the course of the last 24 months is the frequency and severity of these ransomware attacks. And so what it required insurance companies to do was, if I put out, I being an insurance company in this example, if I put out a 10 mil limit for this particular client and I charged $100,000, but I took $1 million loss over the course of 50 or 60 other clients, I've got to reduce my outstanding exposure and I've got to make up for that loss. That happened at such a frequent rate in 2020 based on the pricing of the programs that markets had to make an adjustment overnight as a push of what reinsurers were making them do. So in the simplest of terms, that's been the reason for the effect.
Okay, thank you for that. We use a lot of third-party cloud providers for storage and app.
Yeah. So
how do I determine our exposure through these platforms?
Yeah, so we have, and in conjunction with the Propel and Alera group, we put together a best practices when evaluating use of a vendor. There is definitively a set of questions that you need to be asking every vendor. If you don't have a set, I would start with your own insurance application, right? You're asking yourself, do we do MFA? Do we have offline and immutable backups? Do we have a 3-2-1 strategy for our backups? Those sets of questions, like we are being as businesses evaluated for what we're putting into practice, we should be holding our vendors and third parties to the same standards. We have tools, technology tools. So I alluded to the scanning technology. We have technology tools that we can provide our clients to utilize as they're evaluating vendors, right? To look out and say, externally scanning this particular client, it doesn't score very well. Why is that? It's a fair question in today's day and age to ask that question. And it's fair to to put a checklist as we're evaluating signing on to hundreds or thousands or millions of dollars a year to use these third parties, we need to make sure they're keeping our information safe. And so if I'm putting it simple, let's start with the questions that you all are being asked by the insurance company. Ask those questions of our vendors. If you want to make it more complex, Propel, Alaire, and ourselves are happy to put together a set of best practices for you.
Great, thank you. There's just one more question. We have a smaller business and have considered implementing EDR. It is expensive, so is that something that's really needed to secure coverage?
So that's actually a great question. So EDR is endpoint detection and response. And effectively what EDR came about is taking antivirus software one step further. The way the marketplace, generally speaking, today is looking at it is you have to be above $50 million in annual revenue for the marketplace to unequivocally require that you have some form of EDR solution. If you're under 50 million in revenue, there are markets who will just very black and white say, no, you don't, we're not going to look at your program because you don't have it. And that's the stance they've taken. It's not as stringent as the stance with regard to MFA, but there are markets who look at that checklist we put out and say, we're just not going to do it unless we see these things. We do similar to the insurance companies. And I'd like to make this very clear. There are no, we're not in a referral arrangement with any of these providers, but we do have pre-negotiated rates with XDR, MDR, and EDR providers that we can refer you to if you want to evaluate more aggressive cost structures. Because there are providers out there that focus on the small market. I don't want to name any because I'm in the large market, but there are certainly some ones in the large market that are very well known, but they're also very, very expensive. There are cost-effective solutions that are out there we can help you with.
That's really great to know. Thank you. It looks like that's all the questions that we have for today. So if you have anything else, go ahead and then we'll get things wrapped up here.
All right. Well, thank you, Christian and Michael, for today. That was fantastic. And like Caroline had said, the recording will be available shortly. Thank you all for joining.
Thank you.
Thank you.
Thanks, everybody.